Hello everyone, and thank you for joining us following the publication of our H1 2026 results. To understand the initial market reaction, it is useful to remember why those results, particularly this quarter, mattered so much for Schneider Electric. First, let's have a look at the evolution of the stock market over the last weeks. We could see that after a steady trend of share price increase for the tech companies, starting in late H1, some correction happened to some AI and chip stock prices. Those decreases are on the back of some analysts worrying regarding the sustainability of the growth those companies would be able to deliver in the long run and the uncertainty related to the market they are operating on. Secondly, let's look at ourselves. If during the period we have reached a record high in terms of share price, we have to admit that we globally underperform our peers in terms of stock evolution. And this underperforming is somehow on the back of a year 2025 that was marked as disappointing by the market, especially from an execution and a margin perspective. So basically, what we wanted to demonstrate with those H1 results was giving a clear proof to the market that we are delivering a growth which is sustainable, aka not linked to only one market or one geography, and demonstrate that we are back on track in terms of disciplined execution of our strategy, leveraging our new company program. With Olivier and Nathan disclosing earlier today the results, and for some of you that's seen the share price evolution and some early reactions, we can conclude that the quality of the execution has been recognized by the market, which is a great news for us. In a nutshell, what did the market like in our results? First one, the growth. The growth because it's a broad-based one across geos, across BUs, and across end markets. Secondly, we gave clear evidence of our disciplined execution. Industrial productivity, strong operating leverage, and acceleration of the price realization that, even if not yet compensating the inflation, is actually really speeding up in Q2. And three, what the market liked very much is that with this set of results, we've been able to upgrade our external targets to a level which is much more in line with what investors could expect for a company like ours operating on our markets. Then, looking at the flip side, what did the market like less in what we announced today? First, they looked at the growth rate of our business model, and here they could clearly see that services and software are not growing at the same speed as product and system yet. And back to what I told you before, in a context where we want to make our growth the most sustainable possible, growing on services and software, and especially recurring ones, is super key. The second point that the market liked slightly less is that if they recognize the value and of the initial signal of the strategic rebound that we are having in industrial automation and especially in top line, unfortunately, they also highlighted that the margin of this business is not yet at the level expected by the market, despite growing year over the year. So, with that, and if we want to look ahead, we have been delivering a nice set of results in H1, which is clearly setting expectation for H2. So the encouraging conclusion is that H1 provides further evidence that we are moving into the right direction. For the market, our challenge now is extremely simple. We continue to execute with discipline, we deliver consistently, quarter after quarter. Thanks a lot for your time, and for those taking some well-deserved time off, I hope you will enjoy nice holidays. Thank you and bye-bye.